Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning. Hope everyone had a nice weekend. First week of full week of May, and I hope everybody's feeling good and the families are feeling well as well. So we're going to get started this morning, talk about some macro trends, a lot going on in financial markets, continuation of the uncertainty that we've seen since the pandemic began, and I think we'll have some interesting observations, discussions regarding financial markets, and some thoughts on some ideas given the uncertainty that exists, as it always does, but perhaps to an even greater extent. But keep in mind, uncertainty and lack of clarity is something that is pervasive in our lives and in financial markets, and we're just in a period of heightened uncertainty because we're in a situation that we haven't been in some time, and people who are living today haven't experienced a pandemic like we are in the throes of currently. But also keep in mind that historically pandemics have happened, and that humanity has moved forward after them. So we're going to get started today, talk about a couple of things. Thank you for those of you who sent me some articles over the weekend. Going to talk about two of them specifically this morning. One, which Bruce Reed in Texas had sent me, where he talked about what the world would look like if it were 100 people, and put in perspective how fortunate we in the United States are despite the current situation. I did take the liberty of updating Bruce's statistics to fact check them, and I think that these statistics are something you'll find interesting. So if there are 100 people in the world, about 50 would be female and 50 would be male. 25 would be under 15, and 66 would be between 15 and 64. 9 of those 100 people would be over 65, and that number is expected to climb to 16 out of 100 by 2050. Where they live, 60 out of 100 people would be from Asia, 16 would be from Africa, 10 would be from Europe, 9 would be from Latin America, and 5 would be from North America. That's the United States, Mexico, and Canada. 31 of those people would be Christian, 23 would be Muslim, 16 would not identify with any religion, 15 would be Hindu, 7 would be Buddhist, and the rest would believe in other religions, and that would be 8 people. Of those 100 people, 12 would speak Chinese, 6 would speak Spanish, and 5 would speak English. The rest would speak various other languages. 90 out of those 100 people would be literate and able to read and write. 7 of those 100 would have a college degree. Talking about having a shelter that would protect them from wind and rain, 81 would have shelter from wind and rain, 19 would not. 91 would have safe drinking water, 9 would not. 11 would be undernourished, 1 would have HIV/AIDS, 1 would have tuberculosis, 10 would live on less than $1.90 per day. That's good news, because if we were looking at 1990, 36 of those 100 people would be living on less than 36% would be living on less than the equivalent of $1.90 per day. 87 out of those 100 would have electricity, 13 would not. 68 would have cell phones. 50 would be active internet users. In the U.S., active internet users are 85%. In the world, including the U.S., it's 50%. 95 of those 100 people would live in an area with mobile cellular network service. Sanitation, 70 would have what we would consider working sewers. 13 would have no toilets, and 17 would have possibly toilets but very poor sanitation. Taking a look at savings, about 95% of those people, or 95 out of 100, would have very little to almost no savings. And if just taking a look at here in the United States, 69% of Americans have little to no savings. So keep that in mind as you go about days, weeks, years, and keep your situation in focus. Many days it feels like it's very stressful, that life is challenging, but when you put it in perspective and you consider your situation, the situation of most of your clients, the news is very bright indeed relative to what a lot of others are experiencing. Wendy sent me an article that was in the New York Times that I thought was very fascinating, and that is if you went back 20 years from the end of last week, so May of 2000 to May of 2020, you would have discovered that bonds have beaten stocks over the last 20 years. And that is a very unusual phenomena for those of you who have studied financial markets. Traditionally, over long stretches of time, bonds lag equities, and historically, bonds underperform equities for a good reason. They are generally less risky and therefore have less volatility, and therefore investors are willing to accept lower returns from bonds than stocks. But with all the chaos in the stock market in recent months, and keep in mind in this time period we had the dot-com crash, we had the financial crisis, or the Great Recession, we had U.S. debt getting downgraded, and now we have the pandemic. So bonds have outperformed over these last 20 years as a result of lots of those events, as well as the fact that those events have led to significantly lower interest rates, which is why bonds have outperformed. So here are the annualized returns. The S&P 500 over the last 20 years has returned 5.4%. Long Treasury bonds with a duration of at least 10 years have returned 8.3%. Long investment-grade corporate bonds have returned 7.7%, and junk bonds have returned about 6.5%. Slightly underperforming the S&P 500 would be shorter-term corporate bonds, what many would view as the Barclays Ag, 5.2% versus 5.4% in the equity markets, judged by the S&P 500. Now, this is not to say that investors should load up on either stocks or bonds. What this is saying is no one's got the crystal ball, so another example of why it often makes sense to hedge your bets. Certainly bonds are in some ways riskier now than they were 20 years ago, given how low interest rates have gotten. As we've learned, interest rates can actually even go negative now, but nevertheless, the possibility of probability of that is possibly not as great as rates possibly moving higher, especially with all the fiscal and monetary stimulus that has been unleashed as a result of the pandemic. Taking a look at this morning's news, few different stories this morning. I'll give you an update here on where we are in the futures this morning. Dow futures recovering somewhat, down about 181 points below fair value. S&P futures are down 16. NASDAQ futures are down 35. Taking a look at Asian markets, the Hang Seng down significantly, which was down almost 4%. The Nikkei was down about 3%. In Europe, we are seeing most markets outside of the FTSE, which is actually relatively flat, down anywhere in the neighborhood of 1.5% to 3%. The DAX and the CAC 40 both down north of 3%. Oil down 81 cents a barrel this morning. We're seeing natural gas this morning up about 9 cents, which is about 4.5%. Gold's up about $10 an ounce this morning. And the dollar is slightly stronger this morning. In treasuries, yields slightly lower, pretty much unchanged in treasuries. 2 years at 20 basis points, the 10 years at 63, the 30-year is at a 167. Some news this morning. Apple just announced the new 13-inch MacBook Pro that fixes its keyboard problems. The entry-level model has twice the storage, but costs $1,299. So some news there from Apple. Some other news this morning. U.S. intelligence believes China intentionally concealed the severity of the coronavirus outbreak to load up on medical supplies needed to combat the virus. That's according to the Department of Homeland Services. In addition, Secretary of State Pompeo told ABC's This Week there is a significant amount of evidence that the coronavirus originated in a lab. Over the weekend, Berkshire Hathaway had their annual meeting. Warren Buffett expects some optimism, saying in Berkshire's annual report that America has the magic to overcome the coronavirus over time. Mr. Buffett, however, said the conglomerate sold its entire stake in the airline industry, which has sent shares of the four major U.S. airlines down about 10% this morning. Also, Mr. Buffett said that he did not make any major acquisitions or buy back a significant amount of Berkshire stock. So as a result of those sales and a result of that lack of activity, Berkshire's cash holdings now exceed $135 billion. Said that he did not see any compelling investments. What he implied was that the investments he was interested in have performed very well, and the investments that have performed less well is some of the areas that aren't his particular proclivity for investing. So he has stayed on the sidelines, although did say at any point in time he could deploy $40 to $50 billion if he saw the right opportunity to purchase a stock. Some other news this morning: President Trump's saying he believes the U.S. will have a coronavirus vaccine by January. Dr. Fauci said over the weekend it was doable if things fall in the right place. He said that to Fox News. Also, Wall Street Journal wrote an article on how Florida avoided the worst of coronavirus and proved the most dire predictions incorrect. That coming out over the weekend as well. Saudi Arabia was cut to negative from stable by Moody's. What do we have going on? Look forward to this week. The earnings continue this week. Taking a look tomorrow, we get earnings from Activision, which has been a big beneficiary of the stay-at-home trend, people playing video games. So we'll get more insight into what the trends are in the video game industry from Activision Blizzard. Also get earnings tomorrow from Disney and Electronic Arts, the other big video game maker, Newmont Mining in the gold space. And tomorrow we also get the Institute for Supply Management releasing its non-manufacturing purchases managing index. On Wednesday, ADP releases its national employment report for April. Expectations are for a loss of 20 million non-farm private sector jobs, steepest drop ever. Also Wednesday, we get earnings from CVS, General Motors, PayPal. Costco reports sales for April on Wednesday. On Thursday, we get earnings from companies like Hilton, Raytheon, Viacom, CBS. Also get worker productivity, unit labor costs coming out on Thursday. We get the weekly jobless claims. We get the consumer credit data for March. Going to be watching to see if consumers added to a credit card debt as they lost their jobs in large numbers. And then Friday, we get the report that markets are focused on, which is the Bureau of Labor Statistics releasing the jobs report for April. Consensus estimates are for a decline of 21 million non-farm payrolls after a loss of 701,000 in March. Unemployment rate is expected to skyrocket from 4.4% to more than 16%. Going to move on to Barron's. Barron's kind of a mixed message on where equity markets can go from here. On one hand, Barron's acknowledging that equity valuations have rapidly ascended and may not represent a good entry point, especially with all the uncertainty coming. On the flip side, Barron's also acknowledging that bond yields are extraordinarily low and the alternative for equities is unattractive. So kind of some ambivalence with respect to where to go with equities and bonds. Although Barron's did highlight energy companies very positively. I'll talk about that a little bit. Talking about both energy companies, their stocks and their debt. This morning, Goldman Sachs coming out favorably on some energy stocks. I know they upgraded ConocoPhillips to their conviction buy list. So if you're to take a look at April, which was one of the best months ever in the equity market, best month since January of 1987 for the Dow and the S&P. Dow up 11%, S&P up 12.5%, Nasdaq up 15%. That's Nasdaq's best month since June of 2000. Even more spectacularly, the Dow, S&P, and Nasdaq were all up roughly 30% from their lows hit on March 23rd. And this is leading to some of the conundrum that advisors have, and that advisors when speaking with clients, this puzzle of what to do and where to go next. And Brown Brothers Harriman chief strategist Scott Clemens says that this is what his clients ask most about: is why are we seeing this strength in equities when the economy and the economic data look so poor, and clarity, which is something that equity investors yearn for, is not there. And what he said and suggests to do when looking forward is to take a look at some of the data that's coming out over the next couple of weeks from Georgia, South Carolina, and Tennessee, the states with the most aggressive reopening plans, and see whether or not infections there are rising. That might give you some insight into market reactions, since the markets very much would like to see the economy open up. At the same time, they'd like to see it open up and to see the coronavirus not accelerate. He also points to continuing to follow the news regarding vaccines, regarding Gilead Sciences and their drug remdesivir, which got fast-tracked FDA approval, and those are the signs of optimism. When looking to explain the rapid ascent of equities, he points to the Federal Reserve in conjunction with the federal government and their super aggressive monetary and fiscal stimulus programs, which surprised even those who were expecting an aggressive response from the government. Also very impressed with the speed of the response compared to the government action that we saw in the financial crisis. The speed of help to the financial system from the Fed, and especially from Congress and the President, was unprecedented when you compare it to the financial crisis or the Great Depression, where there was much more foot dragging in both of those instances. At the same time, as a result of those actions, the Fed's balance sheet has ballooned by more than 50%. Currently at $6 trillion. Some economists expect the Fed's balance sheet to go all the way up to $10 trillion. And the Fed has taken unprecedented action by doing things like buying corporate credit, even suggesting that they could even buy equities at some point. That's another risk out there for those who are negative on the markets or want to short the markets. The concern the Fed could step into the equity markets. The Fed took the unprecedented step of saying that they are going to invest in junk bonds. So it's not out of the question that they could possibly consider equities if things deteriorate further. Japanese in their monetary policy have been purchasers of equity. So this mass liquidity that has been provided has been an important reason for the market's recovery, and the question now remains for us to surmise on a daily basis: the stocks correct to reflect the dire economic realities that we see and expect to see over the next few days, weeks, and months, or will the economy hit bottom, begin to recover, and validate the market's apparent optimism? Time, unfortunately, will tell. Perhaps you want to dust off your crystal ball and have some greater insight into that phenomena. This article also discussed opportunities in energy stocks. I mentioned that Barron's ran a separate piece on this. This article took the bent that one of the factors that may benefit energy, in particular oil and gas, is the dollar. And if we were to see some dollar weakness, which some economists are now anticipating over time, given the tremendous debt load and the tremendous stimulus that's been provided, owning assets that are commodities like oil and gas, which are denominated in dollars, would benefit. Certainly gold has already benefited and may continue to benefit from weakness in the dollar if that were to come to fruition. So speaking of some of the other events that took place last week, perhaps one of the reasons for the sell-off in equities, and something else that you could put in the column of things to worry about, is the complexity of relations between the U.S. and China. And at the end of last week, we saw tensions between the U.S. and China re-escalate. The U.S. blamed China for COVID-19, hinted at retaliation. Chinese state-controlled media said the U.S. had failed its own citizens and the world. That's a very strong statement from China, who's usually more nuanced. Meanwhile, the Commerce Department quietly made it more difficult for U.S. companies to sell certain technologies to Chinese companies linked to its military. And the late week ramp-up in tension was definitely significant. And as I mentioned earlier, some of the comments over the weekend indicating that that tension has persisted into the weekend. Speaking about the economic recovery, Barron's headline story was that the recovery rests on consumers and then getting consumers back to spending. One of the more concerning numbers last week was on Thursday. Commerce Department reported that consumer spending dropped 7.5% in March, biggest one-month drop since tracking began in 1959. And the global economy, and the U.S. economy in particular, simply cannot recover without the consumer. As we've heard many times, 70% of total economic output in the United States is driven by consumer spending. What's unique about this recession is that this recession started with the consumer not spending. Usually, crises start in banking or housing, and then leak into the consumer. Here, it was the consumer that stopped spending as a result of the measures put into place to control the pandemic. 30 million Americans have lost their job in 6 weeks. More than a quarter of the 100 largest companies in the U.S. have disclosed furloughs or voluntary leave at low or no pay. That's up 4 times from a month ago. So big companies cutting pay to their workers or furloughing those workers. What's more, we talked about this a little bit earlier in those statistics at the outset of the call. Americans have little buffer. This article citing that more than half of U.S. households, I think I said 59% earlier, don't have any emergency savings to tap into during a crisis. And even in households that earn $150,000, 1/4 of those households do not have any savings to tap into. What's also going on is that consumers have less urge to spend because they feel less deprived because their neighbors are not spending as well. And a lot of America's consumption is conspicuous consumption, whether we acknowledge it or not. Credit card spending for the week ending April 12th was down 34.4%. Debit card spending was down 14%, seeing similar trends in Europe as well. So one of the keys here to recovery will be for consumers to start spending. The silver lining to consumers not spending is that the savings rate is over 13%, numbers we haven't seen in the United States in quite some time. Moving on to the energy stocks, which I mentioned Barron's profiled. Barron's mentioned 10 energy stocks to buy now, where they discussed the fact that the energy zone has been a disaster. The coronavirus pandemic has decimated global oil demand, and what they say is it's darkest before dawn. They're seeing glimmers of hope now that you're seeing painful cuts being made to energy supply. You're seeing companies conserve cash, cut back on capital spending. All of that's going to eventually lead to lower supply and potentially higher prices. These crisis conditions will possibly be made worse by the fact that banks will be very leery about lending to any of these companies outside of the stronger credits. Some companies mentioned in these top 10 picks. I'll mention a few. One of the favorites was Canadian Natural Resources, CNQ. ConocoPhillips, COP mentioned. Also, I mentioned Goldman upping it to their conviction buy list this morning. In the pipeline space, Energy Products Partners, EPD, mentioned favorably. Also mentioned favorably Magellan Midstream Partners, MMP, Williams, WMB. The article talked about that the pipelines were especially hard hit as a result of the fact that many of them are held in closed-end funds. and these closed-end funds are leveraged. And as the market swooned, the leverage in these closed-end funds that held these pipeline companies approached or exceeded 50%, which are the caps or the limits. And some of these funds had to liquidate, even though they may not have wanted to lighten up at that particular moment. They were forced to liquidate these shares at distressed levels in an already weak market, perhaps causing further weakness in some of these pipeline companies. Articles suggesting that some of that selling may be overdone. For those who are interested in the bonds, Barron's also mentioned 10 energy company bonds that could reward investors. The focus here was predominantly in natural gas, where they discussed that natural gas forward prices are up significantly. So if you're looking at current prices, you might see natural gas trading at around $2 per million BTUs, British thermal units. But if you look forward, you'll see that the 12-month price is about $2.70, and 24-month price is closer to $3. As expectations are that natural gas demand will hold firm, which it's been doing, off significantly less than oil. At the same time, there will be less gas produced because lots of gas that's getting created in this country is a result of flare-off from oil exploration, which is declining. So Barron's highlighted a few different stocks. They mentioned Occidental Petroleum. OXY, certainly not for every investor, certainly risky. But what they did suggest is that Warren Buffett owns $10 billion of the preferred stock of Occidental Petroleum with an 8% dividend yield, and now investors can get an 8% yield on the Occidental Petroleum debt, which is senior to Berkshire's preferred position. They also mentioned EQT, which is the largest gas producer in the country. Their debt's yielding almost 9%. Would suggest that perhaps the best way to participate in these opportunities is through a mutual fund with a deep credit bench and experts who can go through the different profiles and pick out what they think makes the best risk reward potential for bonds in the high yield space. Finally, I'll mention one other article, and I'm going to turn things over to Brad. There was an article here talking about all the debt that companies have been issuing as a result of the coronavirus and their need for cash flow. And what the article pointed out is that some of these companies are issuing debt. At the same time, their equities are declining. Perhaps the most obvious example is Boeing, which before the crisis had $5 billion in debt. Now they will have about $50 billion in debt. At the same time, Boeing's market cap dropped by about $100 billion. So even with all the debt that they issued, the enterprise value declined by about $50 billion. This article wasn't suggesting taking a look at Boeing, but using Boeing as an example of some of that transfer of wealth from stockholders to bondholders. But they said that in some cases, take Johnson Controls. This is a company that added $1.9 billion in debt, yet the enterprise value has dropped by $10 billion. So here they view an opportunity to pick up a company that perhaps, while under pressure, some of their businesses, especially their climate business and their security businesses for commercial buildings, could be beneficiaries as companies start building out systems to control viruses. Johnson Controls trades at about 12 times 2021 earnings. Stock's down more than 30% year to date. So while you had $1.9 billion in debt being added, enterprise value declined by $10 billion. Similar thesis on Fox, FOXA, the company that brings you Fox News. Story here is they added $1.8 billion in debt, but enterprise value has dropped $5.3 billion. The shares are down 32%, now traded 11.5 times 2021 earnings. Going to turn it over to Brad, talk some more about the markets, and give you some further insights. Good morning, Brad.
Morning, Keith. Thank you. Morning, everyone. Hope everyone had a good weekend. Those in New York, hope you enjoyed the beautiful weather and got outside. Just a few things this morning. First of all, I have very mixed feelings about whether I miss the days of reaching for 2% yield or what we have now, which is basically a market with anarchy. It's just unbelievable what's going on in the municipal bond market. I've been saying for the last month that municipals have been trading more like equities than I've ever seen in my life. And that being said, I think that you now have to start treating the municipal market more like the equity market. That means if you're an equity investor, you never want to be completely out of the market, but you are always look for opportunities to upgrade your portfolio. So in bonds, you do that through upgrading credit as well as call protection, better coupon. You certainly want to pay up for quality, so you can't lose sleep if you're giving away a bond that you think is going down the tank, and you're paying for something that you think is going to be a survivor, because the rates are pretty decent for everything right now relative to treasuries and a lot of other high-grade products. For new money, I don't think that you should feel obliged to buy long-term bonds. There are plenty of opportunities in the 5 to 10-year camp as well. It's all on a relative basis. It's important to review your portfolios, make sure they're laddered properly by both call and maturity, as well as diversified. Specifically in the market this week, I'm starting to see some new issues that are going to be priced. In New York, for instance, MTA is coming with a $672 million bond deal, and I just noticed about 5 minutes ago that they just announced a $726 million New York City TFA deal. If these deals go off and are priced, it'll be interesting to see how and where they're priced. But once these deals get done, it'll give a short-term calmness to the markets, because it means that the money will be there to pay for the bonds that are coming due. In addition, you have the Fed buying municipals through a municipal credit facility. At the moment, they're only buying states and cities and counties that have a certain population. The market wants to see more, not necessarily from the Fed, but they want to see the government get involved, and they want to see the government actually come in and support the states and the local communities. And the commentary is essentially just between the people on the street are basically saying, government comes in, bails out Wynn and Carnival, and why aren't they going to come on and bail out the states and cities even more? That being said, as I mentioned last week, and we had discussed with Keith, they are not going to come in and bail out pensions. So Illinois is going to have to deal with their pension. New Jersey is going to have to deal with their pension. Connecticut is going to have to deal with their pension, and that's something to keep an eye on. I'll try and get a chart to see which states have the most pension concern, and maybe we'll review that. And doesn't mean to stay away from those states completely, but just you should know what you're up against when you're dealing with those particular securities. Have a good week. Thanks.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.